Hey, welcome back to our channel, where we simplify accounting and finance concepts for businesses and individuals. Today, we're talking about accounts receivable, what it is and how it works, with 3 easy-to-understand examples. So, grab your coffee, and let's get started. First off, what is accounts receivable? Simply put, it's the money owed to a business by its customers for goods or services that the business has already provided but hasn't been paid for yet. Think of it as a promise of payment, a business asset that will eventually turn into cash. Let's break it down with our first example. Imagine a clothing retailer sells merchandise worth $500 to a customer on credit, giving them 30 days to pay. Until that payment is made, the $500 is recorded as accounts receivable on the retailer's balance sheet. It's essentially money the store expects to receive soon. Now, let's look at a service-based business. Suppose a law firm provides legal services to a client and issues an invoice for $3,000, giving the client 15 days to pay. Until the payment arrives, the $3,000 is listed as accounts receivable. It's a vital part of managing cash flow for service providers. Lastly, consider a software company that bills a corporate client $1,200 for a monthly subscription. If the client hasn't paid immediately, the software company records the $1,200 as accounts receivable. These regular transactions are common in subscription-based business models. And there you have it. Accounts receivable is all about tracking the money your business is owed. It's an essential part of cash flow management, especially for businesses that sell on credit. Remember, staying on top of your accounts receivable ensures your business keeps running smoothly. If you found this video helpful, give it a thumbs up, subscribe to our channel, and share your thoughts or questions in the comments below. Thanks for watching, and we'll see you in the next video.